webinar topic is because, it goes without saying that this has been a really unusual year. And more than any other year, this is the time when I have been receiving an awful lot of questions and concerns from physicians, from business owners, and from the general population. And so we're just really delighted to be able to provide some really helpful, useful information and tools for our donors and physicians. So just some logistics before we begin. I wanted to let all of you know that our Zoom webinar is a little bit different tonight. All the attendees are blinded, so everyone is anonymous in this large audience and auditorium, if you will. So you're not going to be able to raise your hand and ask a question live. Instead, what I want you to do is if you take your cursor and roll it over the Q&A button, you'll be able to enter any kind of question that you have for our panelists. And then you will also be able to, in that Q&A box, click a button so that you can remain anonymous in your question if there's a sensitive question that you'd like to ask. We are going to ask you to hold all your questions until the end of each panelist's presentation, where we're going to have, and then we'll have a large Q&A after that. If we do run out of time, please feel free to post and continue to post your questions, because we are going to answer all of them in a further communication with you in an email to all the attendees after our program is over. We do have a stop at 6:15, so some of the panelists may be able to stay a little bit longer if you've got some, burning questions, but a lot of it depends on time. So please remember to post your question in the Q&A if you have one. Okay, and now I'm going to go ahead and introduce our facilitator for the evening. Our facilitator is Mr. Stephen Stubbs. Stephen is the Director of Physician Development at Adventist Health Glendale. He has a very long and illustrious career in healthcare and in business development and physician relations, and so he has his own set of expertise to lend to tonight's program. So I'm going to hand it over to Stephen. It's all yours, Stephen.
Thank you, Irene. Really appreciate putting this together, and that's correct. So, Director of Physician Development for here at Glendale, and as Irene had shared, I've been with Adventist Health for about 20 years. Worked at all three of our hospitals: Simi Valley, Glendale Adventist, and White Memorial. So, very familiar with the physicians. I've probably met you. I also work with Rita Nunez and Romello Markarian. So if you know them, I will work in the same capacity. And definitely thank you, Irene, for putting this together. I think you'll find this very informative, and kind of where there's no perfect crystal ball. It's definitely a good map during such unprecedented times that we have now. During the whole COVID, the upside of that is that I've been involved with a lot of different webinars and heard things as far as how the healthcare environment's going on right now. And a lot of the webinars that I've actually personally attended there's been some Harvard economists and some Fortune 500, a lot of Fortune 500 leaders. And when we went over the presentation today, where I can give you some confidence is it was very consistent with some of the things that I've heard. So the overall and the big picture, this is really to give you a good viewpoint of kind of where things are going, where things are heading. And this is an opportunity, I think, for the hospital and Irene to say that, here's what we're hearing. This is how it can help you as community members and definitely you as physicians out there. So I will hand it off to the speakers. The first is Dave Peniel, and he's a certified financial planner with Bridge Advisory. And then we have Steve Clements, who you may know. He serves on our advisory and governing board in various capacities. He's a partner of the accountancy, also a certified financial planner. And Michael Velasquez, who is the managing partner of the accountancy too, also to a certified financial planner. And both Steve and Michael are CPAs too. So you do have definitely the experts in this field. So I will go ahead and hand it off to Dave.
Actually, Mike is supposed to be driving this engine, but
Oh, okay, okay.
I don't. Mike, are you on there? And if not, Steve, why don't you and I take over for Mike and kind of run this? Mina, if you could load up the first set of charts and just kind of maybe I'll let Steve give it a little bit of an intro, and then I'll talk about the firms and how we're working together and how we can be helpful for people out there who might be looking for assistance.
So thanks, Dave. And if Mike does make it back, we'll let him take over. We've been introduced. Go ahead and move to the next slide, Mina. Our goals are how to not waste a good crisis and understand changes. Talk a bit about post-election scenarios, different tax reduction strategies, and the impact of the potential new tax laws. Retirement, that's a concern for a few of us, and we'll address that along with possibly leveraging your medical practice and looking at other sources of income. And then, of course, we will want to make an offer for a consultation at the end of our presentation. Moving on to the next slide. Specifically, we're going to talk about the post-election updates, tax reductions, math is a way to stop worrying about retirement, reliance, and all of this is involved with change and adaptability, and definitely a Q&A at the end. So, 2 ways to ask: hang on to them to the end or use the Q&A feature. And here we go. Dave, I think you're on.
All right, so let us, I think it might be good for us to give a little bit of background on the accountancy and Bridge Advisory. So as mentioned, Steve and Mike are partners at the accountancy, and I'm the founder and CEO of Bridge Advisory. The accountancy is an accounting firm that's been around a long, long time in Glendale, 30, 40 years, the multiple decades of establishment in the Glendale area. And Bridge Advisory, I grew up in Glendale, and our office has been in Pasadena for several decades as well. And the two of our groups got together recently, the last couple years. And so the partnership of an accounting firm with a lot of expertise and our wealth management firm, we really bring a lot of levels of services to the table for our clients. And so it goes beyond just the traditional accounting or tax preparation or investing your dollars. We really do focus on the planning side. And I want to make that very important because planning does take a lot more effort, and it's a more complicated interaction and the relationship that we have with our clients. But we're very, very happy to have the accountancy as our accounting partner in this. And Steve actually wears 2 hats. He's also not just a tax professional, but he just accomplished his CFP designation, which means he's now very, very elevated in the advice giving and planning side, as well as the investment side. So we're here, and we know we're under shortened schedule, and we know that you'll probably have more questions. And what we're offering up, if it does work for you or you are interested at all, our firms are willing to have a free consultation with you with the meeting with either the 3 of us or together, and we want you to know that's available to you. Mina, the next slide is, and some people ask about, well, what are the different services that you offer? And so if you can see, and this is kind of an interaction of how we could work with a client, whether they be a physician or any type of business group or any client individually. We do everything from tax advice and preparation, personal wealth management. We also can provide insurances and retirement planning. property and casualty insurance, executive benefits. And we also have the capability to do business succession planning. And I know that that seems to be one of the issues that has come up in our discussions lately, that a lot of people are looking to change careers or retire. And that's definitely a hot button. And we believe we're a good group. And one of the things that you really need to do is engage with your advisors if you are planning to implement a succession plan. And it's probably one of the most important things for those of you who are at the later end of their working career. So we're here to help you if that comes up. So part of our, I guess I want to emphasize this is, as Irene was saying, there is a lot of stuff that's happened in 2020. And there were two kind of big things that were happening as we headed into the end of the year or the fall. And that was the election that was coming up. And then what was going to happen with the election, post-election. And then on top of that, we're living in the middle of a pandemic. So for us, this was kind of a dominating feature for this year in how we're doing planning and also portfolio construction. But in this current outlook, it's important to know that what we have now is an environment where there's a lot of turmoil and unknowns. And the two things that we thought we might have a better clue on as we got into the end of the year was the election would be somewhat settled, and that we might have a better indication of where we were with the pandemic. And best hopes were that something would be discovered or that there would be a quick end as we did our lockdown earlier in the year. Well, guess what? Here's where we are. We don't have a settled election just yet. Kind of two things that are still out there. The presidency is still not quite determined yet, although it does feel like or seems like that the Biden presidency is the one that's going to happen. And it also looks like we're going to have divided government, as the Republicans did seem to hold the Senate, although there are two seats that are going to be voted on January 5th, two runoff elections in Georgia. So because of that, we're going to have potentially divided government. Now, what does that mean? And for us, divided government means that there's likely going to be less fiscal stimulus. And even though we're in this very difficult time of coming out of a deep, deep recession, some people are calling it a depression, that fiscal stimulus, which occurred earlier this year, is now starting to roll off. And so for you small business owners who got the PPP loans, that has now ended. Unemployment increased benefits is starting to roll off. And so a lot of people expected a stimulus package to be passed before now, and it hasn't. So our expectation is that probably until, we won't know something until after January 5th, which is the runoff election. So that is where we are right now. And we hope that that gets settled quicker rather than later. But we still have that as an outlier that's causing some concerns about us, about the economy overall. And I will mention this going into the election and going into this last quarter of the year, we still felt that we were in a deflationary environment. So with a divided government, the deflationary forces that are currently in place, we think those continue. I'll be glad to talk about those, and I'll show you why we think that in a little bit of the charts that we share. But note that these are things that we're watching. And if on January 5th, the Democrats sweep the Senate runoff elections on January 5th, and Biden is the president, we expect the deflationary environment that we've lived in the last 7 to 10 years is likely coming to an end. We don't have the time to talk about all the details on that, but that is one of the biggest things that you should talk with your financial advisor about, is what are the changes that will occur should we get a Democratic sweep in January. Now, the other thing is COVID. We've got a lot of issues with COVID. As you know, that we've got lockdowns that are now starting to take place across much of the country. Unfortunately, we're having the second wave. Some people are calling it, I guess, a third wave. And so this is really concerning to us from an economic standpoint, because we do believe that the economic data that was starting to show some improvement is now starting to roll over and flatten out. And if we do get the lockdowns that they're talking about, we're probably going to get another double dip or a reduction back into probably significant recessionary numbers. But many of you are probably aware, there's a lot of really good news about the vaccines that came out this week. Pfizer announced, actually I think it was Sunday night or Monday morning, that they had really good test results, 90% plus on their phase 3 early trials. My understanding, it was over 40,000 people that took place. And the really good news was the side effects were relatively minimal. And then I heard on today that the follow-up results actually raised that number from 90% to 95%. Yesterday, Moderna came out with their news that theirs is also at 95%. And I'm talking to physicians and other people in the medical community, so I'm talking as a layman here, but my understanding is the technology that's gone into these vaccines is using that new messenger RNA technology, which is novel. And the stories we've been reading about this is really, really phenomenal, because it means not just COVID-19 that might be treated, but other viruses or coronaviruses that we've not been able to treat very well. We might have a solution for that, and future pandemics that might be thwarted very easily and in the early stages. So our outlook right now is, with all that's going on, is that we expect a rebound in the second quarter of next year in the economy. Now that's assuming there's no setbacks, there's no additional negative news, the election gets settled, regardless of who wins or loses or whatever. That's our base case of what we expect to happen. Again, we need to see what happens with the trials and the phases that come through. And then I made one little anecdotal thing. What concerned me, and you may have seen this, that the CEO of Pfizer sold a fair amount of his stock the day of his announcement. I've heard different reasons about that, but that's something we're watching, and it just boggles our mind why that would occur. But for now, our outlook is that we think recessionary conditions remain in place for the next 2 to 3 quarters. Let's look at a couple of these charts very quickly, and then I'll let Steve go through his side. But one of the things that we look at is continuing unemployment benefits. This chart basically breaks down by colors the different types of unemployment benefits. And note that you see February of this year, the claims are very low. Then we have the huge spike in going through May and June. And we've been trending down since the middle of June, early July, but it's not going down at the pace that we'd really like to see. And with the lockdowns coming up, we think this number is unfortunately going to trend back up again. And that's unfortunate, but that's what the data's telling us. The next slide, where are we in employment? Remember, that was unemployment claims. This is where are we in the employment cycle. And unfortunately, you can see that we're rebounding, but we're starting to flatten out again. And unfortunately, we're still about 10 million jobs short of where we were going into February. We also look at consumer loans. And because the consumer drives the economy, about 70% of GDP growth is done through consumption. Unfortunately, you see here the sharp drop-off that occurred starting in March. And we have a flattening that started to take place when we opened up. But unfortunately, if you look at that line, we're not seeing that rebound. We're not seeing the pathway back up to the trend line that we had before. So this is telling us that we are not out of the woods, that there's more, let's say, recessionary forces ahead of us. And it's something we're going to watch very carefully. One additional note here, just note that yellow shaded portion is where the recession started. And note that the recession started by the government indicators, that the recession started in February and not in March. when the COVID lockdown started. So we were heading into the year with a recession already in play. It was obviously exacerbated by COVID-19. And now we are waiting for that really kind of acceleration to get out. We just don't see it yet. So that's kind of our view on the economy over the short term, what we see. Now, I'm gonna break it down into two parts here about the markets. First is the bond market, and this is really important for those. Want you to know our view on where we see interest rates, both short and longer term. And what the markets are telling us right now, even with the really, really good news that came out about the vaccine and mostly a settlement on the election, long-term interest rates, though they did back up over the last 6 to 8 weeks, this week have started to trend down again. And this is our view, is that long-term interest rates are still going to trend down lower. So if you're in the market to refinance your house, or you're worried about, you know, buying a home and interest rates rising, then please don't, in our view, don't worry about that. We think the long-term trend in interest rates is still lower. And let me show you why. We talked about the pandemic and how all the spending and government stimulus has come into play. Well, what that's done is increase both government debt, corporate debt, and a little bit to the extent household debt. And this increased debt to GDP, most people think causes interest rates to rise. However, the opposite is the case. If you look at the next slide, I know this is a little confusing here, so let me explain. These are 4 charts. These are 20-year charts for 4 different areas of the world. The United States, top left, the right side top is Japan, lower right is Europe, and the bottom left is the United Kingdom. And there are 2 lines on here. One represents interest rates. The second represents debt as a percentage of GDP. And note that in all cases, that the interest rate is with the line that starts in the top left in all 4 areas of the world. So for the United States, for Japan, the United Kingdom, and Europe, the line that starts in the upper left and goes to the lower right is the long-term interest rate that are currently in play. So in all areas, even though debt to GDP, which is the lower left to upper right trending line, as debt to GDP grows, interest rates fall. And because we know we've added all this new debt from the pandemic mainly, that we're probably going to see lower interest rates ahead of us, not higher. And that trend line is true in all the areas of the world. And I will just make this little anecdotal part that we expect interest rates to probably hit negative on the 10-year treasury. And we're probably in the minority on that, but that's our outlook. The next slide is basically the trend of over the last 30 years of a 30-year treasury bond rate. And we're at 1.6% today. And our expectation that we go below 1% on a 30-year treasury. Now that's the interest rate side. Let's look at the stock market quickly. We want you to know where we are. We still think we're in a bull market, and that's probably going to remain intact for now. But the momentum is starting to show some signs of topping. And we also want to mention that it's really important. US stocks are near all-time high valuations. And I'm not talking about in the last 5 or 10 years. I'm talking the last 100 to 120 years. So we're at levels that are now exceeding 1929 and 2000. So our view is that the stock market's very risky. There are areas of opportunity, but they are very risky. And the things that we follow most, which are earnings and profits, are still declining. The next chart is basically a chart showing 2 lines. If you can see, one's a blue line and one's the red. The red is the S&P 500. That's the price going back the last 10 years. The blue line, surprisingly, because you would think if the S&P 500 is going up at that pace, that corporate profits after tax would be headed in the same level, but they've not. The last 10 years, after-tax corporate profits are actually lower today than they were 10 years ago. This is very, very concerning to us. We are not getting the underlying fundamentals to support the higher and higher stock prices that have continued. The next chart shows what's known as the Buffett ratio or the Buffett yardstick. That's the total value of the stock market capitalization versus GDP. In other words, how much value is in the publicly traded stock market relative to the economy. And please note this chart goes back to the 1970s. We are above now the 2000 internet bubble. This chart does go back into the 1900s, and actually it's higher than 1929 as well. So we're in uncharted territory at nosebleed levels. That's the total value of the stock market versus the economy. Another metric we use is historical earnings, called the CAPE ratio. That CAPE ratio is basically the average of the last 10 years of earnings on the S&P 500, and that's divided by the S&P stock price. And currently we're at 33 times earnings on the trailing 10 years of average earnings on the S&P 500. And just so you know, the average is about 17 times earnings. So we're almost double traditional averages on a price to earnings, and we're at all-time level highs for the Buffett ratio. One last piece. There are some opportunities in the area. I throw this out there because not too many advisors recommend this, but we do like having a little bit of gold in our portfolios. That blue line, that dark blue line there, this is the last 20 years of returns, represents gold relative to the S&P 500, relative to the US bond index, and relative to US treasuries. So if you had invested in gold 20 years ago and held your position, you would have done better than any three of the other asset classes. With that, I'll leave you, and Steve, I'm gonna turn it over to you.
Thanks, Dave. So I've thrown up several numbers on the screen, and let's talk about those. I'm calling this Biden's tax wish list. $400,000 is Biden's definition of those who are rich, those who need to be taxed at a higher rate. We expect tax rates under Biden, if a full Democratic regime gets in both House and Senate, to jump back to the 39.6% rate. He wants to limit the tax benefit on deductions to 28%, even if you're in the top 39% tax bracket. He'd like to tax capital gains and dividends at that same rate, 39.6%. All of this bodes for a trending toward higher taxes, even if the Republicans hold the Senate. There's going to be strong push toward inching taxes higher. And if you think about it, we as a nation, we as a world have taken on such huge debt. Someday, sometime, someplace, we are going to have to pay that debt. And that leans toward higher tax rates. How soon? How quickly? I'm of the opinion that it probably won't happen immediately, but sooner than later. Another number, $3.5 million, $3.5 million. That's the new threshold for estate taxes that Biden would like to have. Currently, it's $11,580,000. And it essentially increases taxes significantly for those who have estates worth $3.5 million for a single individual, $7 million for a married couple. Today, for a married couple, it's over $23 million. He would like to also wipe out the only benefit death really provides. That's something called the stepped up basis. In other words, when someone passes away, the value of their assets steps up to the current fair market value. For example, an investment property that you may have purchased for $200,000 20 years ago, it may be worth $2 million today. In today's environment, you would get a $2 million basis, which means if you sold it today, you would owe no tax. Under Biden's proposed or dream, you would pay tax on $1.8 million. He also wants to create what I call a second donut hole. And the first donut hole, you have many patients coming to you and historically talking about having to pay for their subscriptions during a certain point in time once they exceed so much in prescriptions, the donut hole logic. That went away last year, but Biden would like to create the same for Social Security taxes and have everyone who earns $400,000 or more pay that additional 12.3% or 12.6% additional tax. In other words, Social Security and Medicare would essentially be 15.3% for self-employed individuals, all the way through except for a little donut hole. So, pretty high likelihood. Some of our options. You may want to talk to your investment advisor about taking capital gains sooner than later and starting to reinvest for a new environment. If you are in the 35% tax bracket or 37% tax bracket today, deductions are going to be worth more today than they will if you're capped at 28%. Retirement contributions. Most of you are doing this, and I applaud you. Absolutely, maximize those retirement contributions. That's the best investment I think you can make. Purchasing equipment. We have 100% write-off. We in the industry call it the bonus depreciation. That, for what it's worth, begins to fade in 2023, let alone Biden's probable dream of eliminating it. On another item, there's some of us who are approaching the age 70 and a half. The new rules came out at the beginning of 2020 that the required minimum distribution got bumped up to 72, but there's a rule that used to tie to that said you can transfer money directly out of an IRA to a charity, a qualified charitable distribution. That still holds at 70 and a half. If you happen to be in that age range, take advantage of it if you have a sizable IRA. Definitely work with your accountant and investment advisor to identify steps you can take. And let's talk a bit about the CARES Act. Many of you have already seen components of it. A few of you may have taken advantage of that Medicare advance payment or the rare grant tied to the Public Health and Social Services Emergency Fund, or maybe even the Main Street Lending Program, or perhaps even some of the tax credits. But really, for the most of us, it comes down to that PPP loan, which we as an accounting firm and your accountants are gearing up right now to fill out the applications. We're in the thick of it, working with the clients who are ready to move on it. If your loan was $50,000 or less, you've got the simple application. Simple still means plenty to fill out. But you are not subject to all of the rules about keeping a certain percentage of employees or keeping a certain percentage of pay. If you borrowed more than $50,000, you've got the full-blown application to complete. Some of you also took out the economic injury disaster loan from the SBA. I call it EIDL. We found, for the most part, our clients were receiving at most 50% of your revenue, capped at about $150,000. Yes, there are exceptions to it. But the payback on that is 30 years at a 3.75% interest rate, a very decent interest rate. Along with that, for most of us came a grant of $1,000 per employee and capped out at $10,000, or maybe even some debt relief if you had an SBA loan. The SBA actually paid the payments for 6 months. The SBA and Congress have done a lot of good, but as Dave said, it's running out. Mike, I'm going to turn it over to you at this stage and take it from here.
Thank you, Steve. And emblematic of how this 2020 year is going, I was on the call 15 minutes early and ready to talk to you fine folks. And just as we were dialing in, I had a power surge and my internet was gone. So I was struggling to get back in. I apologize for the inconvenience, but to be perfectly honest with you, I had these beautiful charts like Dave, and I was going to show you a lot of interesting things, but you got my two partners here and they know a lot more than I do. So thank you for listening. Thank you for having me. And we're very slim on time and there's a lot of subject matter to get to. So there's a number of other topics here. Everybody's worried about retirement. What's happening to my 401k plan? I have a retired dentist that came to me and said, Mike, what happens if my 401k plan goes down to a 201k plan with all this COVID stuff? What do I do then? And the reality of it is that you plan ahead. Hopefully you have a dialogue with financial planners that have your back and that are forward thinking to the point where there's contingency plans put in place that that you're not relying exclusively on financial assets. Hopefully you have various buckets of assets behaving in different ways. But one of the ways that we hear our doctor clients talking about is that hopefully some of you have not had their income impacted way too much, but most of the doctors physicians that we work with have had their medical income or income from their medical practices decline a little bit. And so the concern here is, how do I shield myself from not having an over-reliance on my medical income or income from my medical practice? And the reality of that is that the way you do it is you have various buckets of assets behaving in different ways. Hopefully you have real estate assets. You have some insurance assets. You have, of course, the financial and retirement assets. You have your practice income. But you are developing other streams of revenue, perhaps on an active or passive basis, that allow you to reduce that reliance on the medical income. One couple that I can talk about a little bit is he's a doctor and she's a real estate agent. And they also invest in real estate on a passive basis. So there's the medical income, there's the income from selling real estate as a trade or business, but there's also the passive income from real estate activities, which can be a very handsome activity to engage in if you do it right. There's lots of tax benefits, and real estate is one of the assets that is almost perfect. It has appreciation, it has tax benefits, it has cash flow, and the only thing is you can't convert it into cash overnight. So want to talk to you a little bit about forward thinking for your financial future. That's the mantra of our firm, our combined firm of the accountancy and bridge advisory. The space that we live in is this collaboration where all the financial people for our clients are talking to one another. And this inevitably inures to the benefit of our clients. And what this means to you and the value proposition that we want to bring to your attention is that because you've been kind enough to sit through this presentation, we would like to offer you a no obligation, no cost dialogue, if you will, a 1-hour discussion with any one of us to hone in and zero in on some of your personal details that clearly are not going to be aired in a webinar over the internet. So we want to make that available to you at no cost and no obligation with any one of us. So if you do this before the end of the year, that's when we will be available. And after that, who knows what happens. So we look forward to seeing you. Next slide. Thank you very much. Appreciate you listening. I think there are some questions here. Irene, did you want us to look at these, or Stephen, turn it back to you?
Yeah, I'll go ahead and take care.
Okay.
Thank you so much for everything. This is the Q&A session, so got a couple of questions. One kind of real quick is, so we know about the election, but looking at how it's going to happen in January with the Senate runoff, do you think that's going to impact inflation and personal portfolios?
Dave, I think that's yours.
Yeah, I'll run with that one. So yes, the thing to look for here is if there's divided government, that means that there won't be a lot of changes, and the current deflationary or disinflationary forces that exist will stay intact. However, if the Democrats do sweep, then we would expect there to be a significant change in the way in which fiscal authorities and the Fed work together to increase spending, and inflation will ultimately occur. So inflation will come faster with an all-Democratic government run in the Senate and the House and the presidency. Divided government will be disinflationary. Another question, is there anything that can be done to protect assets in the short term? So the note is that if we're not planning for the long term, what can we do in the short term? Best strategy for the short term. You guys want me to go again? Go for it. Yeah. So there's, I think that's the concern, is that people believe we can invest for the long term, and we somewhat disagree with that. So let me take it on face that if you are concerned about the advantages of investing long term, then, and that doesn't resonate with you and you're only looking for short term, the best way to protect your assets, in my view, is to have very high grade, short duration treasuries or other investments. High grade corporates or municipals could be very, very good as well. But you cannot invest in the asset classes that are going to have a lot of volatility. That's the only way you can protect to the downside. So next question, so kind of twofold, but I think obviously we can admit the pandemic has affected the economy. What is your view on how it's affected real estate, both commercial and residential? So for those who hold either commercial portfolios investments or residential portfolios investments.
I can take that one if that's okay. So what we see happening in the real estate markets, those two markets are diametrically opposed. The residential real estate markets seem to be thriving. It's crazy, but there's actually been appreciation in values in many of the local markets. The thing we have to understand about real estate, residential real estate as well as commercial, is that there is no national market for real estate. Every real estate market is local. But as such, in the big metro areas like Los Angeles, New York, major cities, and even suburbs, residential real estate has prospered. It's done very well. A lot of that is tied to there not being a lot of new building. So residential real estate is still very much in demand. Also a function of rates. When you can get a 30-year fixed at under 3%, that's almost free money when you think about it. On the other hand, commercial real estate is the complete opposite of that picture. A lot of people in the office building space are crying the blues. More than likely, we'll start seeing some rededication or repurposed properties going from office buildings to condos or apartments and all things in between. But because of the pandemic, a lot of people, including our firm, have downsized their footprint and have become more practical in their real estate needs.
So next question about cash being king. So is there a good strategy to hold cash, move cash? Any opinions on that?
I guess that falls to me. Our view is that, cash, I don't know if it's king, but it's very close to it right now. We already showed you the charts on the stock market and how relatively overvalued it is to historical precedents. So just be aware that there's a lot of risk to the downside there. Now our view is that holding high grade, intermediate and longer term duration bonds, treasuries specifically, are still very attractive in our view. Even though rates are low, we think there's a lot of appreciation potential there. And if you do have stocks, historically, long-term high-quality bonds have acted as a good hedge or a buffer to declining stock markets. A day like today is a pretty good example. We had a big sell-off at the end of the day in the stock market, and the long-term treasury actually went up a little bit in value. So you had a buffering effect to your portfolio.
May I add something to that, Stephen? So my personal viewpoint on cash is that liquidity should be present only when it has a useful purpose. And I know that it's an emotional reaction with many folks. They feel a lot richer if they see a lot of cash in their bank account, but realize that that cash may not be productive. And certainly there's more than two extremes there. It doesn't have to be all cash or everything in the stock market. There's a lot of in between here, and there's a lot to unpack. And so that's why I think it's important to talk to someone that can give you some guidance.
Stephen, can I add something? Because I saw one of the questions asked about whether we are fiduciaries, and I think that's probably an important one. Yes, both the accountancy and bridge advisory are fee-only firms. We have no commissions in our firms, so yes, we do act as fiduciaries.
And important to understand, I'm sorry, I keep adding to Brother Dave here, but important to understand the meaning of fiduciary is very simply someone who puts your interests ahead of their own. And to that extent, this is where we live. This is our space.
I'd like to add a little something too, in the fact that not all firms are fee only. There are many firms out there that do get commissions and such. Stephen, next question.
So this question relates to capital equipment purchases. So if anybody has an interest in buying equipment for their business.
That's all you, Steve.
Should they do it this year or next year? Do it now or wait?
My strong bias is if you need equipment, don't hesitate. You buy it now. There's almost no limit to how much we can write off in equipment until you start buying $500,000 or more in equipment, and possibly even higher. So if you need it, absolutely. If it's something that's on your long-term horizon, I would start working on it sooner than later. In other words, if you can do it this year and have the net income to be able to shelter, absolutely do it this year. Otherwise, look seriously at next year.
Okay. Next question is Medicare advance payments. Are you familiar with that and how do they help?
Steve.
Let me address that one. The Medicare advance payment was something that's come and gone. It was made available to physicians to get a 3-month advance or 3 months worth of normal Medicare payments. Payback had to begin, well, this started in April. Payback had to begin in August, and it was all due and payable last week. So it came and it went. So I mentioned it just as something that might have been something you saw.
Okay. So Irene, how are we good on time?
I was just going to nudge you a little bit. I think we want to wrap up.
Okay, so time for one more question. So let's assume that either received, a loan or received some investment money. So things related to the cash, but hold on to it or pay off a loan in a lump sum or at an accelerated rate.
Boy, can I take that one? I think that just depends. It depends on facts and circumstances. And, as financial advisors, we like to see the whole picture of someone. So it would be somewhat irresponsible for us to throw out an answer without knowing the big fact base, the big premise of the questioner here.
Okay. Well, as was shared, I have 2 more questions, but want to be respectful of everyone's time. So as our esteemed financial planners have shared, they're offering a free 45-minute consultation, no obligation. So feel free if you have further questions to contact them directly. Definitely thank everyone here at Bridge Advisory Accountancy for their time and expertise this evening. And we're very grateful as a hospital, for their support to our team. So our foundation has recorded the webinar. We'll be sending out a link for future viewing to all the attendees. So if you missed any parts, you want to go back, feel free to look at that link. There will be also some additional information and charts that weren't included in the presentation just because of the time constraints. But thank you all so much for participating. I know for the physician, everybody, I know this is valuable time right now, so do hope you found this informational. And I'll hand it off to Irene, who will close us off.
Thank you, Stephen.
Thank you. Thank you to all of our panelists. And I know we had a couple of little tiny glitches in the back. On the back end of it, but I want to thank everyone for their questions. I want to remind everyone that we are going to respond to all the questions that have been coming in, and we'll do that post-event. So everyone will be receiving this information via email. We will also have this videotaped and ready for posting on our website. So again, thanks to you, Stephen. You did a wonderful job as a facilitator. And our thanks to the accountancy and to the Bridge Advisory Financial Group. Did I get that right, Dave?
Bridge Advisory. Good
Bridge
word.
Advisory.
Yes. Thank you.
Really great partners for our hospital. Steve Clement serves on our governing board, so we appreciate that community support as well. And Mike is extremely active in the community. A real leader in the community, recognized by most people.
Can I say 2 words, Irene?
Sure.
Real quick. To all the physicians on the call, thank you for everything you do. Heaven isn't big enough for you guys. I know these are tough times. Hang in there. We'll all get through it.
And I couldn't have ended it better. So I want to thank all of our panelists. We will be reaching out to you again for another communication with our medical staff and maybe even another group. So thank you all, and have a great evening, everyone. Thank you.
Thanks.
Thank you. Thank you.
Good night.
Good night.
Bye.